Well, hello, everybody. Good afternoon or good morning, depending on where you are. My name is Garrett Schmidt. I am the managing editor for BBC Exhibit Hall. And I'd like to welcome you all to today's live webinar discussion hosted by Alleon Healthcare Capital. And it's titled Leveraging Expected CMS Payments for Working Capital Loan. And it's going to be a very practical presentation. There's going to be a lot of opportunity for Q&A. And we've got a really great presentation in store for us. So I'm glad you all are here and look forward to the presentation today. A couple items of note before we get started. This is a traditional webinar format, so we can't see you or hear you, so you don't need to worry about muting your microphone or turning off your camera or anything like that. However, we do want to hear from you. So at any time during the presentation, you can ask a question. And the way you do that is you have a little control module as an attendee that has a question area on there. So if you would put your question in there at any time, you don't have to wait until the Q&A in order to do that. And then we'll get to as many of those as we can today during the allotted time. If we don't have time, if we run out of time, which sometimes happens, we will get to your question through email afterwards. So go ahead and ask it even up to the last second if we're wrapping up. And then finally, the webinar today is being recorded. So what's going to happen is when we're done, you will receive an email from us probably a couple hours afterwards, and there will be a link to the recording where you can watch the presentation, and also a place where you can download the slides. So those will be provided for you, and some other things that you can get in touch with Alleon or us if need be. So without further ado, I'd like to briefly introduce our presenters today, and I'm sure they'll give you a little bit more in-depth description of themselves and their background. First of all, we have Leon Chernyavsky, who is the managing partner of Alleon Healthcare Capital. And then we also have Ben Rutkovitz, who is the VP of Business Development. So welcome, guys. I'm going to turn it over to you at this time.
Thank you, Garrett. Thank you, everyone, for taking the time to be with us today. We wanted to present today, and I know this is a very sexy topic, so we wanted to be very succinct and hopefully answer any questions that may arise. First, just generally, why would any value-based organization need financing? And I'm sure based on the audience, you guys all understand, the different needs of a value-based organization. Specifically, if you have a risk-based program that's MSSP-based, you get paid once a year, or if you get capitated payments that are monthly, that may not be enough to fulfill a growth plan. You have to meet certain measures and requirements that CMS puts forth, such as the benchmark guarantee. And more importantly, this is a capital-intensive business. So we understand that there's a lot of overhead that goes into it. There's staff and team case management, data delivery, informatics. All of that requires a lot of financial assistance from partners or internally to get the company off the ground and continue operating. Next slide, please.
Hi, everyone. My name is Ben Rutkovitz. I'm just going to quickly give a introduction for Leon. And first of all, I want to say thank you, Garrett and ACO Exhibit Hall, for having us on. And thank you, everyone, for joining us. So my colleague, Leon, is the managing partner and co-founder of Alleon Healthcare Capital. He believes that lending needs a human touch and must make a difference for the client. Prior to Alleon, he was running a hedge fund in the commercial real estate lending space. His hobbies include tennis, DJing house music, and skiing with his wife and children.
Thank you, Ben. And Ben has been with Alleon from its inception. He's a senior vice president and oversees all business development functions of Alleon Healthcare Capital. He also was a business development officer of a bridge lending hedge fund before coming over to Alleon. In his spare time, he likes to attend meditation retreats and spends time with his wife and 2 children in upstate New York.
Okay, Garrett, let's start with the first poll question. Want to get a
Okay.
sense of who's in the audience. Yeah, go ahead, Garrett.
Yeah, go ahead. I went ahead and put it up. Ben, you may not be able to see it from your perspective, but the question is, what role do you play in your organization? And so you can just select one of those, and we'll give it just a moment for everyone to come in, and then we'll put up the results and share them with you. Okay, still give it about 5 more seconds. 3, 2, 1. Okay, here we go. I'm closing, and I'm going to share the results. Ben, are you able to see it on your end?
Yeah,
Leon, you can, right?
I can see it. Yeah.
Okay, you want to go through the results?
So Ben, we have 78% is executive level and 22% clinical,
Got
and
it.
0 from the others.
Great. All right. Thank you,
Okay.
everyone. We'll have a couple of those throughout the session. So, quick overview about Alleon Healthcare. We have been around since 2009. We're a commercial finance company that focuses on the healthcare space. We fund medical providers as well as value-based organizations like ACOs, DCEs, ACO Reach, etc. To date, we funded over 200 providers and deployed over 500 million in assets. We have our main program is the accounts receivable line of credit. We have term loans and special situation loans as well.
So what are some of the financing options for value-based organizations? So as many of you may know, there are numerous options out there. The more traditional one is going to your local bank and trying to get a line of credit of some sort, some kind of cash flow loan. That seems to be the first approach. The pros of that is that it's, the bank may be local or national presence. You will likely pay a lower interest rate than you would with other options that are on the table. And it could be a trusted partner for you going forward, knowing that you have a bank behind you that can fulfill your financing needs. However, as we all know, banks, especially now, have recently tightened up. They have a lot of requirements and covenants that are more strict than other non-traditional sources. They require additional collateral, such as real estate or some tangible collateral that you would need to put forth to be able to borrow from them. The process is lengthy and bureaucratic. They would want you to have certain number of years that you're in business, typically 3. And through that time, they want to make sure that the company has had positive EBITDA to make it easier for them to get approval inside their investment committee. And lastly, banks nowadays have had a really hard time understanding the risk-based agreements and just the value-based process from understanding the contracts and getting comfortable with the collateral. So most of them are not accepting applications from these types of entities without a strong backer or additional collateral. Next, please.
So the next major financing option for a value-based organization is a non-bank asset-based lender. Some of the pros are that asset-based lenders, especially ones who are healthcare focused, are specialized. They understand the medical industry from accounts receivable, revenue cycle management, and most importantly, risk-based agreements. The asset-based lenders have flexible terms with light covenants, especially when we're comparing it to the options here on this presentation. Most likely the quickest due diligence and closing time is going to be with your non-bank ABL or asset-based lenders. Typically it takes us about 3 weeks to put the facility together. Positive EBITDA in terms of financial historical performance is not a requirement with an asset-based lender, and credit blemishes are also okay, from bankruptcies and other issues like that that could be a deal killer at a traditional bank. The cons are that these types of institutions are typically pricier than a bank, the interest rate is higher, and they're less well known than the traditional banks.
The third option is equity, getting an investment, direct investment in a form of equity from either your partners or a third party. And that could be a good option for some. The pros are it's a partner that has the same strategy in mind and is focused on growth. It's kind of an exit down the road. There's no interest expense typically for equity transactions. So it leads to higher cash flow in your business and the ability to meet your operating needs. The cons, however, it's probably the costliest option out of the three that we've mentioned. Your partner may have a different time horizon for an exit. Most equity investors in private equity or maybe family offices may want to be in and out within a 5-year time frame. And that may be different than what you, as the owner of the value-based organization, is interested in. They will also put forth unfavorable restrictions for management and the founders, such as the salary restrictions potentially, or additional items that they feel is necessary for them to incentivize the founders to be on the same page as the equity owners. A lot of the equity investors will want to see a track record before investing into the company. And size does matter with an equity investor oftentimes, because they don't want to write small dollar tickets, so they want to make sure they're investing into a company that is a certain size now and has growth potential towards an exit a few years down the road.
Okay, Garrett, let's hop into the second poll question, and if you could just read it out loud, because I'm not able to see it.
Sure thing. Okay, so it is up for everyone. And this question is, what is the ownership structure of your organization? The choices are privately held, institutionally owned, hospital owned, or other. And we'll give this a moment to gather answers here. And if you're not sure, go ahead and just put other. Okay, give it about 5 more seconds. 5, 4, 3, 2, and 1. Here we go. Okay, we had one more come in. All right, I'm closing it out, and we're going to go ahead and show the responses. All right, Leon, are you able to see the?
Yeah. So we got 56% privately held, 22% hospital owned, and 22% other.
Got it. Great. Thank you, everyone.
All right.
All right, so let's continue. We often find it's best to talk about and present the financing option through a case study, a real world scenario. So this is a recent client of ours. It's a value-based healthcare organization based in the southeastern United States. It was coming to us as it was transitioning from a DCE to the ACO REACH program. And the company needed working capital for various reasons. Number one, to assist with the transition. And number two, there was a reconciliation where CMS stated that there was a deficiency owed to CMS by the value-based organization. And the organization also didn't have a lot of time to meet that deficiency. So it came to us seeking $3 million. And in the next slide, we're going to talk a little bit about how we structured it, collateral, etc.
So this structure is our typical structure for a value-based organization. At the core, it's a senior secured loan. We put a UCC lien on the business. We write it for anywhere between 1 to 3 years, depending on the needs of the client. The amount that we're able to advance to the client is based on 3 months of capitated payments. The advance rate is typically 80% of the borrowing base, which is 3 months. And then we amortize it over 12 months with an option to reborrow. So this part is a little tricky because it really depends on when the company is coming to us for financing. We typically will not take reconciliation risk into our consideration. So we would typically come in and provide financing to an entity, but we'll end up amortizing it for a period prior to the reconciliation. So once the reconciliation is done, and if it is positive, the client can then come back to us and reborrow under the same facility without having to start from scratch. So what that would look like in a typical scenario is assuming your reconciliation is complete in August and you owe funds or you will receive funds by September of the following year. Let's say you came to us in January, we would give you an advance based on your borrowing base, and then we would amortize it over the next 9 months. And then once the reconciliation is complete and positive, you will then be able to come back to us and borrow again the same amount under the borrowing base. Now, the borrowing base may go up or down depending on your assigned beneficiaries and any kind of additional beneficiaries you may have throughout the year. So it gives the clients an opportunity to shorten their collection cycle. They have access to capital sooner than they would, and they're able to then reborrow after the reconciliation is complete, so that they can continue with the working capital needs that they may have. So that's on how much they can borrow, but from a structure standpoint, it's very similar to a revolving senior asset-based loan. You're going to have cash dominion procedures in there, which is very typical for any traditional bank as well as an asset-based lender. You're going to have certain guarantees, covenants in place, and that is deal specific. And obviously, some of these items are negotiated depending on the structure of the value-based entity, as well as its needs.
Okay, so what is the financing process like? I'll walk you through a typical scenario. We'll usually have an initial call to talk with the client, get comfortable with the client, its background, and learn about the company. The next stage for HIPAA compliance is we'll sign an NDA or business associate agreement, depending on what's necessary for that particular deal. We'll send out an application and request some due diligence items initially to determine the revenue stream from CMS. So that includes reporting and historical data as well. If we're comfortable at that point and we have high confidence that the deal is for us and can fund, we'll issue a term sheet. The term sheet will break out the rates and terms, our responsibilities, the client's responsibilities, and if the client likes the term sheet and executes it, then we go into the second stage of underwriting, if you will, we'll order third-party background checks on the entity, on the principals, and that includes UCC, credit, tax liability, all those kind of checks that are standard with most typical loan underwriting. Then the next stage, along with the third-party background checks, is underwriting. And so we'll dig in deeper and we'll verify the initial reports that we got in the pre-term sheet stage. And we're basically verifying all the information we got earlier and getting comfortable that this is a loan that we can do. Once that green light comes from underwriting, it goes to legal. The lawyers will draft up closing documents and we go into the closing / funding stage. From beginning to end, on average, this takes 3 weeks. And we say average because it depends on how quickly the client gets his documentation, whether the deal is clean, where any flags come up. And we have funded in under 3 weeks, but I would say that's a good average for you to keep in mind. Okay, Garrett, let's go into the third poll question, please.
Okay, pulling it up here. All right. Leon, you want to read this one out?
Sure. What is the size of your organization by annual revenue? 0 to 20, 20 to 50 million, 50 to 75, 75 plus.
And obviously all of this is confidential. It will not be shared with anyone. Okay, looks like we have most of our results in. And give it about 5 more seconds. 5.
And Garrett, I mean, if I'm correct, we don't even, Leon and I don't even see who answers what, right? This is
Right. Yeah, this is just to gauge the audience. Okay. Yeah. All right, and we are going to close it out now. And I am showing the results.
So 80% 0 to 20 and 20% 75 plus. Interesting.
Okay, great.
Okay.
Thank you guys for that. It's helpful for us. Okay, I'll talk about the document list, and this is specifically after a term sheet is executed in that second stage of underwriting where we're verifying in putting together the packet. So we are looking for, we want to understand the ownership structure, how many entities, how many principals, etc. Business name verification, and that includes formation docs, articles of incorporation, etc. for the entities. Employee org chart, specifically what we're interested in there is a high level understanding of the key officers and key employees in the organization, who they are, what they do. CMS contracts, obviously in the value-based world, that's very important for us to review those and understand the timing, deadlines. Then in terms of licenses, medical license verification, business state operating license. And then next, we request access to the 4i portal. This is so that we can independently pull the reports that we're looking for and do our analysis. Next, we look for copies of tax returns for the last 2 years. Obviously, if the organization is newer than that, all these are flexible document lists. This is just a generalization, but we do look at the tax returns. We want to see financial statements. Most important are P&L, balance sheet, and a debt schedule. We'll take a look at the last 12 months of bank statements, copy of the policy and procedure manual, and if if available and if relevant, copy of all correspondence related to audits by CMS.
So once we receive all those documents, we'll dive in, we'll analyze them, and we'll sit down as a team. We have an internal investment committee. We don't need to, we need to go out to outside sources, and we in particular, some asset-based lenders are bank financed. We are not bank financed, so for us, we don't have the same red tape that some other entities may have. But at the end of the day, we still have to meet as a team and evaluate each client that comes through our door. And what we focus on in our underwriting and approval meetings is, number one, management team experience. It's very important for us to know that who we're dealing with are people that have been in the medical field for quite some time, have experience in the value-based world or the managed care world, really understand the ins and outs of value-based care, and it's a fairly new structure in our healthcare system, and it requires a lot of compliance and a lot of knowledge of what's required from CMS. So we make sure that the management team is on top of it and is in compliance with all the CMS requirements that are needed for them to be approved to operate and then to continue operation, because it's very important for us to make sure that the business stays operating throughout the life of our loan. Reporting is very important for us. It's less so it's less so in the management team's radar at this point, because I know that there are a lot of reports that go through the 4i portal that are given from CMS. We use those reports to do the analysis, and I know that usually management is able to grab some of those reports and massage them to make sure that they're within the right risk profile that they need it to be. So it's important for us to know that the management team, once again, is on top of all the reporting requirements. Historical performance is important. Ideally, we'd like to deal with value-based entities that have been part of the value-based system. However, it's not a requirement for us. We are totally okay funding new value-based entities. We've done that in the past. We funded new DCEs, we funded new ACOs, and now with ACO Reach, just recently started, I'm sure there's some new entities that we may take a look at. As long as they know what they're doing, or they were maybe part of a DCE in the past or an ACO, we should be able to get comfortable with them. And lastly, financial strength is important. Although our main collateral is the capitated payments that are received from CMS, we need to make sure that these payments are enough to service our debt, as well as take care of the entity to make sure that it's continuing to operate. Because at the end of the day, we never want to enter into a sick bed, nor do we want to enter into a transaction where we're not helping in any way, shape, or form, as opposed to where we're hurting them, because we're adding our interest that they'll have to pay us, plus all the working capital needs they may have as a business. It may put a strain on the company, and we're not interested in being part of that equation. So we evaluate everything as a whole, and then we either approve it or deny it, or come up with some specific covenants that maybe will make us comfortable, and as well as make it work for the client. So that's our main focus when it comes to underwriting.
Great, thank you. At this point, we'll take a pause. Garrett, if there are any questions, we're happy to answer them.
Yeah, all right. So, well, this was great, guys. There's a lot of, there was a lot here, and we do have some questions that came in. So we'll begin here in no particular order. By the way, if you do have a question that you want to ask these guys, in your attendee module, there's a little area for questions. So go ahead and put those there. and we're going to get to as many of them as we can. All right, the first one, and again, in no particular order, and some of these may be repetitive, so I apologize if they are. In terms of credit blemishes, are you okay with previous bankruptcies?
Got it, Ben.
Yeah, short answer, yes. Long answer, we look at a deal holistically. So if the rest of the deal is good and we're comfortable with it, and a bankruptcy on its own will not preclude us from doing a deal.
Okay, great. Next question is, what are the upfront costs?
Sure, I can tackle that. So we have third-party costs that are necessary for us to do the underwriting. There are background checks on the entity as well as some of the key members. We'll have to do lien searches, searches on the entity as well to make sure there are no judgments or any lawsuits outstanding that may hinder approval. We also obviously will need legal to start doing their work. So our typical due diligence expense requirement is anywhere from $5,000 to $10,000, depending on the size of the transaction. It could be an entity that has 4 entities underneath its holding company, and we'll have to do analysis on all 4 or 5 of them. So that obviously will require more upfront. We don't charge for our underwriting. We do our own underwriting in-house. We don't outsource that to anyone. So that's why we're able to keep the cost down to just third-party expenses, such as lien searches, as well as tax searches and entity searches.
Yeah, just to piggyback on that, 2 things. That fee is only charged and requested after initial due diligence and a term sheet is issued. Number 1. Number 2, if for any reason the process gets stopped and the loan doesn't fund, we refund that deposit minus actual costs incurred. And so probably less likely in this space, but what happens sometimes is we'll get the deposit, we'll run the checks, and there's, principals have like insurance fraud or something major in their background check. We'll stop the process and refund everything minus that particular check.
Right.
Great. Yeah, good to know. Okay, next question here is, to what indicator do you tie interest rate? Is it prime, LIBOR, or other?
So we tie to prime. About 90% of our deals are tied to prime. The other 10% are tied to SOFR. So it really just depends on the environment at the time, but most of our deals are tied to prime.
Very good. Next question here is, how long is the process? How long does it take?
Yeah, I think we mentioned this a little bit in the presentation, but overall, it's about a 3-week process. When we get the initial information, and as long as it's clear and we have everything we need, then we can issue a term sheet within 24 to 48 hours of getting that initial information. After that, once the term sheet is executed, that's when we go into the next stage of the underwriting, the third-party background checks, legal, closing, etc. And again, about 3 weeks in total.
And it really depends on each client. Some clients have the information readily available, like Ben said. Other clients, maybe they're just closing the month and they're requesting us, why don't you guys wait for us to close this month, and then we'll give you the updated financials in a week and a half from now, but we'll sign the term sheet now, so that will get extended. So it really just depends, but overall, 3 weeks is a safe average.
Okay, great. Next question here is, do you offer strictly working capital, or do you offer reinsurance services as well?
We do not offer reinsurance. For those type of services, we have a couple of entities that we work with. We're happy to make referrals, but no, we don't do it ourselves.
Okay, great. Next question is, how much historical data do you need?
So the general answer is the more the better. But as Leanne mentioned during the presentation, we have worked with new entities. And so kind of the general rule of thumb is the less historical data we have, the more we're going to lean on the underwriting of the management team and how comfortable we can get with them and their expertise.
Yeah, very good. And then next question here is, what has been your client default rate?
So historically in the value-based space, it's been 0 because it's so new. But
I'm knocking wood over here.
Yeah, I'm knocking wood, knocking this wood, any wood. But you know, it really depends on the year. We've had some years that we've taken some hits because of fraud. You know, that was unfortunate, but it actually helps you learn what is needed to see the potential fraud. And it really puts the focus on the fact that you're dealing with people and not just businesses. And it's the people that pay you back and not the businesses that pay you back. So our analysis of the management team is very important to us from the start. So that's why we put a lot of emphasis on it.
Yeah, great. And one thing that's actually all the questions that we had that came in. But one thing that I did want to ask you guys about, and it's something we've spoken off mic about, is the anonymity of the whole process. I know that's important to a lot of your clients. So can you speak to a moment or to that for a moment in terms of
Absolutely.
what you do in that
Yeah,
regard?
absolutely. So most of the time, if not all of the time, we sign an NDA right from the start to make sure that our clients feel comfortable with sharing information with us. We do a minute audit on the business, so we're going to want to know a lot of things. And we have no interest in doing this type of business ourselves. We have no interest in sharing that information. We've been around for going on 14 years now with no issues around that whatsoever. So we value our clients, we value their privacy and respect their confidentiality, and we sign any necessary agreements that we need to sign, including HIPAA, because when we deal with non-value-based entities, there's a lot of patient information that potentially needs to be protected, and we sign all necessary agreements and take all measures that are needed to make sure that that information is safe in our hands.
Yeah, very good. And from my own experience with these guys, they're very, very careful with even disclosing who their clients are to protect that anonymity. So definitely, I think you can trust these guys in that regard. But that is actually the conclusion of the questions. So we're going to wrap it up here. But as we close out, I wanted to encourage all of you who are in attendance today or who are watching this after the fact is you can reach out to Alleon Healthcare Capital either directly, and I'll show you how to do that in a second, or if you want to visit their virtual exhibit booth at vbcexhibithall.com, you can do that. This is a little snapshot of what it looks like. There's some information there that you can read about what they're doing in the value-based care space. There's a little flash interview that kind of gives a rundown of what they're doing. So a lot of good stuff there. And of course, obviously, if you'd like to reach out to them directly, if you want to go to that last slide, Ben, you can reach them here. So their information is here, or you can reach out to me. I'm happy to put you in touch with either of them. And yeah, they will tell you what to do and go through it all with you again. So that's it for today. Thank you guys so much for coming. We're glad that you spent your afternoon with us, and we look forward to hearing from you. And we'll see you on the next webinar.
Great.
Thanks.
Thank you so much for your time.
Bye, everyone.
Bye.
All right. Bye-bye now.